Hey guys, today we're going to break down candlesticks for beginners, but not in a boring, what is a candlestick way. We'll cover the candlestick and what it is quickly, and then we're going to jump into 5 advanced tactics that you can use with candlestick trading that most traders never use, kind of pro secrets. So let's jump right in and quickly run over what a candlestick is. First, a candlestick is made up of a couple of parts, the body and a wick or a shadow. The wick can be above or below the candlestick. The body can be wide like this one, or it can be narrow, or basically it can have no body at all. So you just have a line right here. And all that means is that the stock opened and closed at the same price. Okay. The candle can represent basically any period in time. It could be a 1 minute candle, or it could be a monthly or a yearly candle. So this entire candle can encompass, again, a minute or a year. With a green candle, this is the open. What is happening in this time frame is the stock is moving from this opening price down to this low, up to this high, and then closing here. So in this time frame, again, whatever time frame it is, the price range has moved from this high to this low, opens here and closed here. So for example, if this is a 2 minute candle, it could have opened here at 0 seconds, moved here 30 seconds into the candle, started moving higher, and say at a minute 30 into the 2 minute candle, it's at this high, and then it pulls back. And at the 2 minute mark, this is where it closes. This candle just shows the same range, but with the opposite movement. So it opens at this point and closes at this point. And we can go through the same scenario very quickly. It opens here, again, at the 0 seconds on the 2 minute time frame. Let's say it moves up here 30 seconds into that 2 minutes. Over the next minute, it moves lower to here. So now you're a minute 30 into the 2 minutes. It bounces back up in the next 30 seconds and closes here. So that's the basics of how a candle works. Green, it's open lower and closed higher. Red, it's opened higher and closed lower. So now that we've covered the basics, let's jump into some of those more advanced strategies. And to do that, we are going to look at candlesticks in their native environment, which is the stock chart. This is a trading view chart. And the first thing we're going to talk about is the ratio of wick to body. When you have a large wick like this, these are called bottoming tails or bottoming wicks. Another name for a wick is a tail, right? So for a bottoming tail, which indicates there's a very high likelihood your stock or ETF, this is the cues, is going to move higher, you need a downtrend, bottoming tails. And what those bottoming tails are telling you, and we're focused on these 2 bottoming tails here, right? What they're telling you is that sellers or price action lower is being rejected. That's why you get a big move down and then a move up in the same time frame. A big move down and then a move up in the same time frame. It's important that we have this downtrend in place for these to be bottoming tails. Because if you don't have a downtrend before these tails, they're not bottoming tails. Perfect example up here, these tails are not bottoming tails because you're in an uptrend. So you have to have bottoming tails after a downtrend, and you have to have topping tails after an uptrend. So you can only have a topping tail, and I'll zoom in on this so we can see it even a little better. This is a topping tail. It's also basically what's called a gravestone doji, but it's a topping tail because it happens after an uptrend. Bottoming tails after a downtrend, which usually mean the price is moving higher. Topping tails after an uptrend, which usually means the price is moving lower. And here's a bonus. It's not part of the 5, but you can have something called a tweezer bottom. This isn't exactly a tweezer bottom because you can see that the price doesn't go down in the second candle. I'll make this bigger again so we can see it. The price doesn't touch to the exact point that it did in this first candle, but this is a special type of bottoming tail. You can have a tweezer bottom or you can have a tweezer top if you have 2 candles with topping tails together. And that's usually a very good reversal sign. So our first advanced strategy, recognizing bottoming tails and topping tails. Now let's look at our second advanced strategy, which is something that throws off a lot of new traders that are using candlesticks. Remember when we were talking about a green candle being an up candle and a red candle being a down candle? Look at this candle in Amazon. Note this candle. You would think that this is a negative candle because it's red, but in the charting software, it's only covering the time frame that you are assigning for each candle. So this is a daily chart. So this is the daily candle. And what happened with Amazon with this candle, and I'll make it just a little bit bigger, is that the price opened here, at some point traded up to here, then traded lower to here, and then finally closed here. So you would think that's a negative candle. If you just saw that candle, it's negative because the price moved lower during the day than where it had opened. But look at the gap, right? This again is the daily chart. This is a very positive, strong move higher, even though the candle is red. So when you get a gap like this, you may have what looks to be a negative candle, but it's actually a very positive candle, even though it's red, because you had this gap higher in price. And look what's right beside of this candle, a topping tail the next day, and we move lower, right? You had an uptrend, a topping tail, again, almost a gravestone doji with this, again, long topping tail, and then a move lower. I'll go over gravestone dojis in another video. That's number 2, that the color may be a little bit misleading. Now let's talk about the midpoint. Midpoints are important because they often form retracement levels where if you're looking at a candle, especially a larger candle, and you get a move in a certain direction, and this is an example here, we have a move lower, which is a continuation, right? We get a large candle, and when the stock, and this is Google, when the stock tries to bounce, it bounces over a 3-day period about to the midpoint of this candle. You run into resistance and we move lower. So I pay attention to midpoints, especially of large candles. Look at this candle, have a strong move higher, and the retracement, right? That's the pivot point retracement. It's about to the midpoint. it holds that midpoint the next day, and you get a move higher. So a midpoint of a large move should be a point on the chart that you note, even if just mentally, to see if it turns into a retracement zone. Let's look at another one that looked like it may turn into a retracement and then didn't. And that's this one. We had this big move down. The stock over the next 4 days basically tried to retrace. It got to that midpoint. And when it was able to break above the midpoint, it shot higher, right? So it broke through the resistance. And once it broke through that midpoint, it was able to move up. So that's advanced tip number 3. Pay attention to midpoints, especially of large candles when you have a retracement. Now let's talk about strategy number 4, which is basically when a candlestick pattern sets up and then fails. And what happens when you get a failure of a pattern that should be working is you can get a fairly big move in the opposite direction, as people have taken advantage of the pattern that's playing out. So they're positioned in one particular way, long or short, and now the stock moves against them. Here's a good example. In Google, you had a downtrend and then a bottoming tail, and then a move higher. It got to 50% of this large candle, moved through that, retraced, but then you got a second, what's called a doji candle with a bottoming tail. And this also could have formed a double bottom, basically at these two spots. So you had indications that Google may start to move higher. So if you were long in this area, paying attention again to those bottoming indications, your stops would have been just below this double bottom. So when this happened the next day, the stock opened here, tried to move up, but ran into resistance as sellers came in at these levels. All the people that were long here were getting out. So when the stock rallied up off this bottom, everyone had already gotten long with these indicators and they were selling into this day. So you had an outsized weakness over the next couple of days as this pattern failed, as all these stops were triggered as the stock tried to move higher. And now on to our final pro tip, advanced strategy. And in this one, we want to talk about time compression. So this is a chart of the cues. This is the 5-minute time frame. And you have a very clear hairpin turn here. I'll make it a little bit bigger. You have a hairpin turn, you have a bottoming tail. It is very clear on the 5-minute chart. The buy point from this hairpin turn is here, right? As it clears this large red candle, these two candles combined. That's the buy point trigger. Now let's go to a 15-minute chart and look at the same thing. And on the 15-minute chart, this buy trigger didn't happen until here. And you wound up catching a lot of the move, but you made a lot less profit on the 15-minute. See how the candles are changing shape and size and buy triggers when you go to different time frames? This is called time compression. So on different time frames, you'll get different buy signals and different sell signals. Let's go to the 2-minute chart with this same pattern or the same time that we're looking at. You end up with basically a W pattern. That's a little off, but close to a W pattern here. And with this W pattern, the buy point is the midpoint. So there's the buy trigger. and it happens to align with the 5-minute buy, but you can see it's a totally different pattern, right? You've got a W pattern in your candlesticks as opposed to a hairpin turn pattern, which is what we got on the 5-minute chart. One of the things to be really aware of, and one of the big reasons that I flip between different time frames, usually a 2, a 5, a 15, and an hourly for intraday, is that you can get conflicting patterns on the different charts in different time frames. So you could have a buy setup on the 2-minute, but a sell setup on the 15-minute. And you need to be aware of that. And I'm not checking it every time I see a buy setup on the 2-minute, but you need to be aware that could be happening, because what that tends to do is dampen the potential gain in whatever setup you have, because you're fighting against another time frame. And it's just easier if all the time frames are either in alignment. That's the best case scenario. You've got a buy setup on the 2, the 5, the 15, and the hourly. That's a very, very strong buy setup or sell setup, whichever it is. It has a very good chance of working. Whereas if you have conflicting time frames, it has a lesser chance of working whatever time frame you're on. Think of it as all the horses. If you have 4 different horses pulling a cart and they're all pulling in the same direction, that's going to work a lot better than if you have one horse trying to head off to the left, another horse trying to head to the right, and then you've got your 2 other horses going straight, right? Then you've got a problem. So that's the final advanced strategy around candlesticks, is switching between those time frames. So we talked about wick-to-body ratio, topping tails and bottoming tails. We covered that bonus, the tweezer top and the tweezer bottom. We talked about how candle colors can be misleading. You can have a gap higher and then a red candle, but it's actually a very positive move, even though the candle is red. We talked about sort of midpoint magic, right? That midpoint needs to be paid attention to, because you can often get a retracement at that midpoint. We talked about when a pattern fails and how you can get a strong move in the opposite direction because you've got everyone going one way and now the market moves against them. And the last thing we talked about is time compression, flipping between different charts. Again, depending on what time frame you're trading, if you're doing more swing trading and you're looking at 2 to 3 to 4 day trades, you may be looking at a daily and a weekly and an hourly chart. If you're looking at intraday, you're looking at a 2, a 5, a 15, and an hourly. So that is basics to very advanced. I will be doing more videos on technical setups, candlesticks, as well as other technical indicators. So keep an eye out for those. If this is a video that helped you, please hit like and subscribe. Feel free to ask me any questions in the comments. I try to answer all questions there. And look for that next video on more technical analysis patterns. Thanks for watching.